Recently, we've been covering some of the big players in gold mining, like Newmont and Agnico Eagle. In our latest video, we highlighted how Newmont snapped up some high-quality, low-cost gold reserves through their acquisition of Newcrest. This move has left other major mining companies under pressure to find new reserves that we all knew they would eventually have to go out and get, especially with gold prices on the rise and production running at full tilt. That eventually for replacing reserves is now coming a lot sooner than expected. It's important to note that each of these companies have their own approach when it comes to reserve replacement. They've got unique strengths, different core strategies, and varied priorities. Some of these companies avoid politically risky regions, while others are willing to take the gamble. Some are ready to buy fully operational mines with cash in stock, while others invest in their own exploration teams to discover reserves on land that they already own. They may outline their strategies in broad terms, but these companies often surprise us. So honestly, we don't always know what they're planning to do. But what we do know is how to evaluate a gold company. Today, we're taking a close look at New Gold, a Canadian operation that in our view is primed to make the most of this hot gold market. Let's dive in. New Gold is a Canadian company running two active mines, Rainy River in Ontario and New Afton in British Columbia. Together, these two mines produce around 400,000 gold equivalent ounces per year. We're talking equivalent ounces because New Afton doesn't just produce gold. They also bring in significant copper and silver. We'll dig into those details in just a moment. The reserve bases as of the end of 2023 include 2.5 million gold equivalent ounces at Rainy River and just under 2 million ounces at New Afton. Okay, let's talk big picture here. If we take the company's 2023 production rates, then look at the proven and probable reserves, that gives Rainy River around 5 years of production and New Afton around 11. New Gold currently has an enterprise value of $2.4 billion, and by most traditional measures, it's fairly valued within its peer group. It's trading at roughly twice its book value, twice its sales, and 5 times its cash flow. Given the high gold price, it makes sense that New Gold will be producing and selling gold as fast as their mills can handle. This strategy, though, will burn through their reserves faster, raising the inevitable question of how they'll replace them. Fortunately, exploration is in New Gold's DNA. Rainy River, one of their mines, is a well-known Canadian exploration success story from Eastern Canada. The gold complex that feeds this 12,000 ton per year operation today was found buried under 30 meters of glacial till. Glacial till is basically a mix of boulders, rocks, and debris that got churned up over millions of years as massive glaciers slid across the land, grinding and scattering everything in their path. It's basically junk. Typically, gold deposits are found in areas with light ground cover where prospectors can study the bedrock geology, examine outcroppings, and do surface sampling to home in on potential targets before they start drilling. But with Rainy River buried under 30 meters of boulders and gravel, there was no way to see the bedrock. Finding a gold deposit is already like finding a needle in a haystack when you have the surface in view. Here, they were looking for that needle under a thick layer of glacial debris. Even so, the glacial till had enough trace amounts of gold to keep prospectors interested. They figured there had to be a deposit down there somewhere. So they took a systematic approach to it, drilling reverse circulation holes into the overburden and keeping meticulous records of the samples. By analyzing the gold concentrations and studying the shape of the gold grains in the till samples, they were able to identify the general location of the gold deposit, an area where gold had been smeared across 20 kilometers by ancient glaciers. Even after pinpointing this, it took more drilling and exploration to fully delineate the mineral reserves. Finally, in 2017, the Rainy River mine began commercial production. The open pit mine was set to wind down production this year, but recent drilling could lead to another extension. Meanwhile, the underground Intrepid zone east of the main pit, which started up in 2022, is still going strong. On top of that, an underground extension of the main zone began production this quarter, coming in ahead of schedule. All of it remains open at depth, and New Gold's exploration teams are still hard at work. The company has even budgeted another $3 million for further exploration at Rainy River in 2024. New Afton, the other mine, is located near Kamloops, BC, conveniently close to the Trans-Canada Highway. Originally, it was an open-pit copper mine operated by Teck Cominco, but they abandoned it in the 1990s, choosing to focus on other large, bulk tonnage copper projects instead of investing in exploration to extend New Afton's life. The ground was later staked, and an extensive exploration campaign got underway to prove that New Afton had the tonnage and grade to support an underground operation, not just as a copper mine, but as a gold mine. This deposit is polymetallic, meaning it contains copper, gold, and silver. Running New Afton isn't cheap though. Mining the ore costs between $40 and $50 million per quarter. If you treat the byproduct revenue from the silver and copper as credits against the cash costs of the gold ounces, the New Afton gold ounces can be mined at a negative cash cost. I like the sound of that. Negative cash cost. Commercial production at New Afton began in 2012, and since it's grown into an advanced, efficient, and modern underground operation. So far, they've mined 56 million tons, with over 100 million tons already drilled out across all resource categories. But as always, we have to ask, where are the next 100 million tons going to come from? At New Afton, the answer is likely from the same spot where the first 56 million tons came from. This whole project began as an effort to explore extensions to an already produced deposit. Since production began, they've steadily added enough new tonnage to keep operations running through 2031. Just this quarter, New Afton started mining the C-Zone with a modern materials handling system designed to help keep both costs and emissions down. Meanwhile, exploration at New Afton is going strong. The team is testing targets below and behind the C-Zone as well as in the nearby K-Zone, where some recent drill results have been pretty impressive. Engineering a mine is a tricky, delicate job. It's all about extracting the most value from the rock at the lowest cost while keeping everything stable. Structuring the capital that keeps the mine going is just as challenging. Remember when Newmont released their earnings and everyone was up in arms about their all-in sustaining costs? Instead of declining, all-in sustaining costs jumped again in the quarter, climbing to $1,611 per ounce. All-in sustaining costs, or AISC, is a non-GAAP metric created by the World Gold Council to keep mining companies transparent about their true mining costs. But here's the thing. Even though AISC includes a company's on-site and off-site costs, plus taxes and royalties, it still leaves out corporate overhead, exploration, reclamation, and especially capital costs. Money has a cost. If a company isn't careful about how they raise capital, they risk weakening their balance sheet and driving up the true all-in cost of the ounces they mine. In Q2 of 2024, with byproduct credits from Afton factored in, New Gold reported an all-in sustaining cost of $1,381 per ounce. According to the World Gold Council, this places them somewhere around the 30th percentile of gold producers, a relatively strong position. But drilling out future production is expensive, and when gold prices dip, stock prices usually follow. To avoid stretching their treasury too thin, New Gold sold a free cash flow interest in the New Afton mine to the Ontario Teachers' Pension Fund back in 2020. The Ontario Teachers' Pension Plan took 46% of New Afton's free cash flow in exchange for providing New Gold with $300 million to help secure their next decade of production. This deal allowed New Gold to keep building while maintaining a relatively low cost of capital, but at the cost of a portion of their operating income. Those royalties, after all, come straight off the top line. New Gold also pays a gold royalty to Royal Gold on production from Rainy River. These royalties are the trade-offs they made to preserve their treasury in cap table terms. Getting creative with debt and royalties allowed New Gold to modernize, bring production online, and invest in their assets' future, all without diluting their treasury. Thanks to this approach, their share count has remained steady, allowing them to drive future income and growth to the bottom line for shareholders. 4.5 years later, New Gold just exercised their option to buy back about half of the teacher stake for $43 million, right as they're gearing up to bring the C-Zone online. As a producer, New Gold might seem fairly valued, but the real upside here is in their development potential. Right now, there's no defined end to either of those systems. Both are high grade and both represent extensions of already operating projects. New Gold's commitment to drilling out these two active areas is what gives the company a chance to move into a larger league. Remember, the capital investment to build and commission these projects is already behind them, and they managed to do it with minimal dilution. Any additional discoveries at either site would extend the life of mines already in production. So, while New Gold is a producer, it remains very much an exploration play. The stock has been doing well, and investors are betting that good results from the extension drilling at New Afton and Rainy River will drive it even higher. Like any gold company, New Gold is sensitive to the price of gold. But thanks to New Afton's copper component, they're also exposed to copper prices, which helps keep costs low. Guys, what do you think about New Gold? Or are there any other gold or mining companies that you'd like us to cover? Let me know what you think in the comment section. And guys, if you enjoyed this video, please do me a favor, smash that like button, subscribe, and ring that notification bell. All the engagement keeps us going and tells us that you want us to make more of this content. Thanks for watching, everybody.